Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's have a look at some of the guests we'll be bringing you on the show today. It's a busy one. How close is Canada to having a Canadian dollar-backed stablecoin? We'll hear from Didier Lavallee. AI is likely to continue being the primary growth driver of the markets next year and beyond. We'll speak with Mike Taylor on how you can separate hype from value. The woman of the hour, Alberta Premier Danielle Smith, will be here to tell us what this pipeline deal means to her province and the country. All right, let's get to some of the stories we're following in the BNN Bloomberg newsroom. Prime Minister Mark Carney and Alberta Premier Danielle Smith have signed a new energy agreement. The plan is aimed at reducing Canada's dependence on the U.S. while unlocking the full potential of Alberta's energy resources. It indicates Ottawa's support for one or more new oil pipelines with a route that increases export access to Asian markets as a priority. Ottawa has also agreed to suspend some environmental policies for Alberta and will adjust a tanker ban on BC's north coast if necessary. Canada's current account deficit shrank in the third quarter. Data from StatsCan shows the deficit narrowed to just under $10 billion, led by a contraction of trade in goods as exports rose while imports declined. Investment income and trade in services also contributed to the overall narrowing of the deficit. Shares of Algoma Steel are trading higher, 4.5%, after the federal government announced a new 25% tariff on about $10 billion worth of steel derivative imports from all countries, including the U.S. One analyst at RBC Capital Markets says despite the move, the Canadian market is still expected to end up in a position of oversupply. Now, on the upside, Ottawa's plan to reduce freight rates for interprovincial steel transportation should increase demand for Canadian steel and make Ontario steel more competitively priced. And taking a look at the markets, you can see the TSX continues its rally, albeit slowed down a little bit. It's up 0.1%. And of course, the U.S. markets closed for the Thanksgiving holiday. And to talk more about the fact the markets in the U.S. are closed for the holiday and other options, our next guest says increasing non-U.S. investment will strengthen your portfolio resilience and long-term outcomes. Let's welcome Reinhard Root, Global Equity Portfolio Manager at 91. Reinhard, thank you very much for joining us.
Hi, Roger. Lovely to be here.
What do you like to see as a balance when you're looking outside of the U.S.?
Look, I think if you're looking at investing outside of the US, the question is always profit growth. I mean, it's been really one-way traffic for a number of years, right? I mean, the sheer dominance of the US market, not only really because of the big tech names. Obviously, tech earnings have done significantly better than the broader market, and that continues to be the case today. But if you go outside of the US, you are looking for different types of exposures. You know, market structures are quite different. You know, if you look at Europe, it's got much more energy, more materials, more industrials, more cyclical financials, and like emerging markets, you know, greater or higher growth consumer exposure. But what gets you to invest outside of the US is ultimately access to diversified earnings and different streams of earnings. But obviously that earnings has to keep up with what's available in the US, which obviously explains why the US has done very well relative to many other regions up until this year.
And let's stay with the European for a second here. Banks, industrials are one of the areas you have interest in. Any concerns right now with what is unfolding between Ukraine and Russia? The idea that there may be a settlement or it may continue.
Look, I think at least in the near term, it seems like a ceasefire is likely. Clearly, you know, we get new information on a daily basis, so who knows where it will end up. I think what takes a step back, though, I would say that on a multi-year basis going forward, I think Europe has woken up. I think Europe realizes that they need to increase the level of GDP spent on defense. I highly doubt that is going to change, and I think the the percentage that they will be spending on GDP will be at least at the level set out, or maybe even increased. So I think, one kind of has to take a slightly longer term view beyond the shorter term gyrations, and it's very plausible that one might in fact see like a ceasefire, but if anything, I think in the sell-off of some of those related sectors, such as European defence, for example, that might actually provide quite a good buying opportunity.
And just going to jump over to Japan. You've expressed interest there, but there's a lot going on right now there, isn't it?
Yeah, it is. I think the key change in Japan is really just the rise of inflation. It's obviously an area where there hasn't been inflation for a long period of time. So it's interesting to see how companies and businesses cope with that, the ability to pass on price increases for the first time, and that is presenting quite interesting opportunities. And then there's also corporate reform. I think a lot of Japanese corporates have been very conservatively managed, have hoarded quite a lot of cash on their balance sheets. So it's quite pleasing to kind of see them becoming somewhat more investor or shareholder friendly and redistributing some of that cash back to shareholders.
And any concerns about potential rate increases there from the Bank of Japan?
Yeah, look, I mean, that's bound to happen. It does seem like the Bank of Japan is somewhat behind the curve, like a bit, which obviously does explain some of the weakness in the currency. But I think that is very much the path of travel. The Bank of Japan seems to have done that in quite a measured way, which is always good to see, and that gives the consumer and businesses, kind of like a bit of time to recalibrate and deal with a higher interest rate environment.
And part of the success for the markets outside of North America, outside of the U.S., the weakening of the U.S. dollar, where do you see that heading in the coming year?
Look, it's always hard to call the level of the currency, but when currency shift starts happening, it tends to last quite a long time. So currency cycles can be multi-year in nature. And it's safe to say that we have just come out of a multi-year US dollar bull market. So, I mean, while I'm probably not in the camp of rapid, US dollar depreciation, I do think there's a case to be made for a dollar cycle that is less strong than the one that what we've seen previously. And markets are made in the second derivative, so it's often the rate of change that kind of matters more than the absolute level itself, and that's why it's kind of easy to kind of see why investors are looking beyond the US. Not only because of potentially more revenue growth opportunities, but also that the currency tailwinds which they might get from potentially a less rampant US dollar.
Okay, and then just to bring it back full circle to the American markets, which are closed today, where does that leave the markets heading into the new year, do you think?
Look, it's been a really strong year, clearly. Broadly speaking, returns have been quite robust. And obviously the US market has participated in that. I think it's interesting if you look at market structure. Obviously big tech is a large say percentage of the US market in particular, but on a look-through basis, broader tech and AI beneficiaries as a percentage of the overall market index is probably at its highest in the US, which has kind of helped it. But it's at the same time, it's interesting to see that other markets have in fact kept up with that. So, I mean, we're of the view that corporate profit growth looks quite resilient. I think at the moment, earnings season looks quite solid, and on balance, I think more companies have beaten earnings than kind of missed. So we are reasonably optimistic into year end.
All right, we'll wrap it up there. Reinhard, thank you very much for joining us.
Thank you very much.
Reinhard Root is Global Equity Portfolio Manager at 91. Coming up, how close is Canada to having a Canadian dollar-backed stablecoin? We'll get more on that after the break. Well, earlier this month, the federal budget tabled a framework for a Canadian dollar-backed stablecoin. Our next guest says that with proper regulation, this new digital currency would ensure the Canadian dollar remains relevant on the global stage while protecting its sovereignty. Joining us now to share his thoughts on the new framework and what is still needed for Canadian stablecoin regulation is Didier Lavallée, CEO of Tetra Digital Group. Didier, thank you very much for joining us.
Thanks for having me.
What do you like about what we saw in this framework that is released, and what do you think still needs to be changed?
I think there's a lot of things to like about what was released. Specifically, I would say the first one would be the speed at which they release something. So really, a great amount of respect for Minister Champagne's office and essentially our Premier Carney for getting their act together and getting something out quickly. So that would certainly be the first one. Now, the second piece I would say is around what's missing. I mean, we have a construct. It's a great starting point. I think there needs to be further alignment and further definition as to what a stablecoin will actually do for Canadians and how that needs to be properly regulated, specifically around the jurisdictional challenges, whether it's provincial regulation or federal regulation.
And what would you like to see it do? What do you think we should do provincially or federally at that level?
I think the budget did a really great job and the draft legislation highlighting that stablecoins should be payment tools and they should be regulated as such. Yet we still have a provincial construct around making them a security. So I strongly believe the ideal scenario is stablecoins should be utilized as payments. They should be federally regulated. And the draft legislation gets us partly there.
Do you see provinces saying yes to that?
Great question. I mean, I would argue that likely not, because we saw a prospectus this week being issued to a Canadian company via Ontario. So, with that signal, I think the provinces are sending an important message that they still believe that jurisdictions should be at the provincial level, at least until there is a federal framework into law. Just a reminder, we're still very much at the draft stage right now.
And now, what do we need one for? What do we need a stable coin for? A lot of people, I think, are still trying to figure out the whole cryptocurrency, Bitcoin, Ethereum, now the stable coins. What do we need one for, do you think?
Yeah, so stable coins are really just a representation of a Canadian dollar. It's a digital representation. It also makes it transacting that Canadian dollar internationally and locally a lot faster and quicker and cheaper. And then there's a programmatic aspect of being able to transact a digital dollar. So from a treasury management perspective, from a settlement perspective, from a counterparty risk perspective, there's a lot of benefits. I think most Canadians trust their financial institutions and therefore they trust essentially the banking rails. But Canada has been behind on a lot of different frameworks that have been globally adopted, including open banking, which we saw some strong signals on the budget, and real-time rails, which we still don't have. We're the only G7 country not to have. Stablecoin is an extension of all these great innovations in the financial sector. And we see a lot of benefits to both ourselves, to Canadians, and also to businesses that are transacting both domestically and abroad.
And why peg it to the Canadian dollar? Why not just go with the American?
Also a great question. So the problem with when you utilize a US dollar stable coin is essentially you're buying US treasuries. And that's a problem for Canadians because you're supporting the US economy. Now, as Canadians or proud Canadians, there's a sovereignty aspect here. And we should want to utilize the Canadian dollar for our transactional businesses, both domestically and abroad. So, the concept of a Canadian dollar and why it matters is because we're supporting Canadian treasuries, the Canadian economy, as opposed to supporting somebody else's currency.
And there'd be no problems using it elsewhere?
Yeah, so that's part of the construct and part of what needs to happen, where players like Tetra and to the marketplace are working really hard to ensure that there's a capacity to transact that internationally as well. We've announced a couple of high-profile partners as part of our original announcement, including players like Wealthsimple, Purpose, ATB Financial, National Bank, and Shopify. And we're also working actively with other global partnerships where the Canadian dollar is an important piece of their transactional system, or creating, a G7 basket for digital asset currencies. Our capacity at Tetra to essentially seed that liquidity will be incredibly important for that success.
Okay, we're going to leave it there. Didier, thank you very much for joining us.
Thank you so much for having me.
Didier Lavallee is the CEO of Tetra Digital Group. Well, Prime Minister Mark Carney and Alberta Premier Danielle Smith have signed a major new energy cooperation agreement. BNN Bloomberg's Lindsay Biscay will be here with the latest on it. Prime Minister Mark Carney and Alberta Premier Danielle Smith have signed a major new energy cooperation agreement outlining the conditions that need to be met for a new bitumen pipeline to deliver Canadian oil to the Pacific. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. Lindsay, thanks as always for joining us. There's still a lot lying ahead.
Yes.
What have we've talked about this for a few days. What do we now know?
Well, now we know some of the conditions that need to be met before this kind of pathway towards this pipeline can actually start going ahead. So among some of the conditions, some of the bigger ones in this MOU, Alberta has to sign on to an industrial carbon pricing agreement to lower emissions by 75% over the next 10 years. Alberta also has to extend the carbon capture incentive program. This is one of the largest carbon capture projects ever. And according to the MOU, this is a big part of it because the Pathways carbon capture and storage projects is directly linked to any pipeline. One cannot happen without the other. That's what it says in the MOU. In response to that, the federal Liberals will not be implementing a cap on emissions from the oil and gas sector in Alberta. So this kind of lays out all the groundwork for the possibility of a pipeline, but also clearing the way for other pipelines as well. That's something that was mentioned in the MOU. It says it focuses on constructing, quote, one or more pipelines financed by the private sector with Indigenous cooperation, so potentially more in the future after this first one. And then that's the other part of it. The Prime Minister says if there's not a private sector proponent, there will be no pipeline. So there's a lot of conditions here that have to be met, all in tandem with one another. A tanker ban exemption is possible too. This is something that's been talked about quite a bit, but that would be the last step in all of this. The MOU makes it very clear. Everything else has to happen first before there's even a consideration of lifting that tanker ban.
And of course, not everybody's happy with the idea. The Premier of BC, David Eby, has been very vocal in his opposition. Have we heard anything, or what's happening there?
I've been checking to see if he's posted anything or put out a statement since this MOU was signed just last hour. Nothing yet, but he has been very vocal about this, the Premier of BC, because most of the risks associated with this project could affect BC if something were to happen. There's risk to water, fisheries, long-term health as well. And David Eby's made all of that clear. In this MOU, there is a commitment to dialogue with BC. It says, quote, to ensure BC shares the economic and financial benefits of any project that goes forward. But so far, the BC government, has not been included in talks about this MOU before. David Eby making that very clear, saying Alberta and Saskatchewan have both been included, not him, although he did have a phone call recently with Prime Minister Mark Carney. Also, many of the coastal First Nations not quite on board with this, against the idea of pipelines, of tankers on their coast. And that consent and support by First Nations is needed for this to go ahead. So that's another part of that MOU as well.
Okay, so lots.
Yes.
Right. Lindsay, thank you for that.
Thanks.
And that was BNN Bloomberg's Lindsay Biscaya. Well, investors are calling for more measures to take the profit out of a market manipulation tactic called stock spoofing. As W5's John Woodward tells us, modern techniques are making some investors a lot of money while authorities are trying to catch up.
Randy Manzardo spends his retirement in Coquitlam, BC gardening. His tomatoes are growing fast. His stocks, not so much. His retirement plans are in jeopardy.
It's disheartening and it made me a bit angry.
He invested tens of thousands in one stock in particular, Quantum Biopharma, believing their drug for multiple sclerosis showed great promise in mice.
When they put these announcements out about how good this was, it would drop. And I've done enough investing that when there's a great announcement, it doesn't drop, it goes up.
Randy thought something was up, and so did the people at Quantum Biopharma. They've sued Canadian banks, alleging their stocks were driven down by a market manipulation tactic known as stock spoofing, demanding $700 million in compensation. The banks have denied this.
Quantum is just an example of what's happened to the whole sector.
Terry Lynch is the CEO of Save Canadian Markets. He believes spoofing is on the rise. Players using computer programs or algorithms he calls algos, faking orders by the thousands to drive stocks down. They profit, he says, by short selling, essentially a bet that a stock will drop.
And it's just they just have algos making, $1,000 here and $500 there and $300 there, and you make it on 200 companies. It adds up to real money over time.
Stock spoofing prosecutions in the United States show that techniques that were cutting edge just a few years ago have now become much easier to do at scales never before imagined. American authorities have been busy. The largest settlement so far, J.P. Morgan Chase paid $920 million to settle allegations of hundreds of thousands of fake orders. They're also prosecuting Canadians operating there. That includes an alleged stock manipulation case of an Ontario man, Alexander Milrud, whose network in Korea was allegedly making more than $1 million a month. And TD Bank paid more than $20 million to resolve charges relating to a former trader's alleged actions. Spoofing is illegal in Canada. Records show the number of proceedings against so-called market manipulators has doubled from just 5 in 2022 to 10 last year. But in that time, total fines never rose above $1.05 million.
What we need is the court systems to send some messages out there to say, hey, we need to stop this. You need to be punished, and now you need to get reform.
Lynch believes another way to stop spoofing is to take the profit out. He's pushing for restrictions on short selling. A report for the Ontario government recommended some short selling restrictions. That was 5 years ago. It's still in progress. We caught up with Ontario's finance minister.
Where are we on those recommendations and protecting investors?
We expect all market participants to follow the rules.
You might be aware of a lawsuit that alleges even some of the big banks were engaging in some predatory practices like stock spoofing. I mean, is it so widespread that even the big players are doing this?
Look, we have enforcement and everyone's got to follow the rules. I'm not going to comment on anything in front of tribunals or courts right now. But make no mistake, we are always there to protect the good actors and go after the bad actors.
Over in BC, Randy appreciates the sentiment, but he doesn't feel he can compete.
It's such an uneven playing field for average guy like me.
He's hoping his quantum stock turns around because he's not sure he wants to take another risk with his retirement.
And that was the third and final installment of W5's John Woodward's report. Up next, as AI is likely to continue being the primary growth driver of the markets next year and beyond, we'll speak with investment managers on how you can separate hype from value. We'll be back in a moment. Prime Minister Mark Carney and Alberta Premier Danielle Smith have signed a new energy agreement. The plan is aimed at reducing Canada's dependence on the U.S. while unlocking the full potential of Alberta's energy resources. It indicates Ottawa's support for one or more new oil pipelines with a route that increases export access to Asian markets as a priority. Ottawa has also agreed to suspend some environmental policies for Alberta and will adjust a tanker ban on BC's north coast if necessary. Shares of Rogers Sugar are edging higher today, about 1.5% right now. The sugar producer posted profit and revenue in its latest quarter that came in above expectations. The Montreal-based company says the results were driven by disciplined execution and consistent demand from customers. It is currently focusing on expanding its refining and logistics capacity in eastern Canada to support evolving demand. Shares of Algoma Steel also trading higher, about 4.2%, after the federal government announced a new 25% tariff on about $10 billion of steel derivative imports from all countries, including the U.S. One analyst at RBC Capital Markets says despite the move, the Canadian market is still expected to end up in a position of oversupply. On the upside, Ottawa's plan to reduce freight rates for interprovincial steel transportation should increase demand for Canadian steel and make Ontario steel more competitively priced. And taking a look at the markets, only one to look at right now. Fairly quiet day, but the rally continues at a lesser pace for the TSX. It's up 0.1% and well into record territory. And of course, the U.S. markets closed for the Thanksgiving Day holiday football extravaganza. While choosing winners in the AI race can be challenging, but my next guest sees growth potential in various areas of the market, not just in the high-flying big tech companies. Let's bring in Mike Taylor, investment manager at Baillie Gifford's Global Alpha team. Mike, thanks very much for joining us.
It's a pleasure to be here.
With everything that's unfolding with AI, it's almost like every company is essentially becoming an AI company, isn't it, with the way it's becoming integrated?
That's right. The point here is that this is a general purpose technology. There's almost no industry that it won't impact ultimately. So finance is an obvious example, but healthcare. I even met a company last year that was using the technology in a sawmill to identify areas of the production line that were going to snag before they did so. So this is general purpose. I have heard it described as the invention of the printing press. The implications are so profound.
And where do you see, which industries do you see benefiting the most? You mentioned a few there. Which ones are you looking at and keeping a closer eye on to see what kind of a difference it can make?
What's really exciting at the moment is it's not clear just yet. At Baillie Gifford, what we're trying to do is look out over 5 years. So at the moment, probably the most profound impacts have been in the areas of coding, but I am really excited about the broader implications. What about the healthcare space? How can we develop our understanding of our own genomics to come up with new drugs, new therapies that will make lives better for sick patients across the world?
And I mean, we're starting to see that. It's the speed, I think, is what makes a difference with AI, isn't it? The speed at which these things can unfold.
Absolutely. It's remarkable. I mean, one of the trends we've seen over the last 3 years is that the chips that are powering this revolution, NVIDIA's GPUs, are getting more and more powerful. So whilst they're expensive bits of kit, the end customer is getting more and more performance per unit of cost spent on them. And let's not forget, this industry is still constrained. Customers cannot get enough chips. So they're still figuring out what to do with them. The implications of the long term are not yet clear, but they are going to be remarkable, in my opinion.
All right, let's stay with these big tech companies. Are there any concerns, any companies you see concerns with? You mentioned trying to meet demand is a challenge right now.
Yeah, it certainly is a challenge. I think that that is a result of the fact that NVIDIA is about the only company that can really design the cutting-edge chips, and TSMC is the company that just about the only company that can really make them efficiently. So there are a couple of bottlenecks. I think it's also fair to observe, however, that the big hyperscalers are putting a lot of money to work. They're not finding they're not being too restrained in their ability to deploy capital into this space. And I think that will, in the long run, benefit those companies as well as obviously benefiting their supply chain.
And what about Palantir? It's trading at a high valuation, just looking at this, but still demonstrating strong fundamentals. Is it still something for investors, or should they avoid that for now?
Palantir is not a stock that I am particularly close to, but I think whilst shares can go up, one of the most interesting and difficult things to get your head around in investing, I think something that we do well at Baillie Gifford, is that a share can go up, but it can get cheaper. And what I mean by that is if the share price has gone up, but the growth opportunity has expanded, or that company's ability to execute on the opportunity has improved, then actually it can be even better value even as the share price goes up. That's why we're still enthusiastic about companies like NVIDIA. But on Palantir, I'm afraid I don't have a strong view for you. Okay,
fair point. What about AI within emerging markets, and what are you seeing with that there? What kind of an impact is it having there?
What's really interesting about the current situation is that AI is accessible globally. So emerging market companies are able to access this technology. They're able to experiment with it just like companies in the more developed world. In the spring of this year, I was out in South America, and I met almost every company that I met there is using this technology. A couple of ways they're doing that. One example would be using it to do sales processes. So one business I met had reduced their sales staff from over 200 to a tiny fraction of that, and using AI to fill in the gap. Customer satisfaction levels actually increased when that happened. So it's being used across the emerging markets as well as the developed world.
And do the companies in those markets, are they doing it at the same pace as what we're seeing here?
I say the more forward-thinking ones are. It's very easy to access the technology, right? Mm-hmm. It's probably fair to say at this point that most data center build-out is occurring in the Western world, so there's probably more capacity there. But if you are a forward-thinking emerging market company, you absolutely can access the technology.
And now you're talking about South America. Any other emerging markets that have caught your eye with that?
I'm a China bull at the moment. At Baillie Gifford, we're always trying to look out 5 years. We're saying what businesses are going to be meaningfully bigger in 5 years' time and what companies are going to dominate those industries. I would say I still expect the electric vehicle industry to be meaningfully bigger in 5 years' time. And at the heart of that are Chinese businesses. So, for example, I'm a big CATL fan. This is a company that makes the batteries that go into electric vehicles. It's got a market share of over a third. and it's a superior businesses to other players in the space. So their technology is better, their ability to package battery cells is better, and their ability to manufacture them. So what I am trying to do on the Global Alpha Fund at Baillie Gifford is look across the globe and say, what companies are going to be meaningfully bigger in 5 years, and what businesses will dominate those industries.
Okay, we'll leave it there. Mike, thanks very much for joining us.
Thanks for having me.
Mike Taylor is an investment manager at Baillie Gifford's Global Alpha team. Coming up, Prime Minister Mark Carney and Alberta Premier Danielle Smith have signed a deal that paves the way for a new pipeline to the West Coast. We'll have more on that. Prime Minister Mark Carney and Alberta Premier Danielle Smith have signed an energy deal which includes a pledge for a new bitumen pipeline that would go through British Columbia to the West Coast. The pipeline would open the export of oil to Asian markets and suspend a number of environmental regulations for Alberta. Let's get more now from Danielle Smith, the Premier of Alberta. Premier, thank you very much for joining us.
Yeah, my pleasure.
Is this the next step in a journey of about 1,000 kilometers? Is there still a lot to go?
Well, I can tell you that Alberta had 10 pretty bad years with some terrible laws that really dogpiled on our oil and gas industry, and quite frankly, looked to us like they were intended to shut in our major industry, which is not only vital to our economy, but to the economy of all of Canada. And with this agreement today, we see that the federal government under Mark Carney is prepared to take a different approach. And we're pleased to see that. The removal of the emissions cap on oil and gas, I think, will give additional confidence back to our energy sector so they can expand production. Ultimately, expanding production will make pipelines possible, as well as the elimination of the clean energy regulations applied to our electricity sector should result in reinvestment in natural gas energy production, which we hope will fuel an AI boom. So those are some pretty key elements to it, not to mention the commitment to work together on getting a new 1 million barrel a day pipeline to Asian markets and have a carve out on the tanker ban to make that happen, as well as developing additional infrastructure for carbon capture, utilization, and storage. I mean, I had a big list of things that I wanted to address, and most of them have been ticked off.
Now, there's some things you have to do. The carbon price, industrial carbon pricing is going to jump to $130 April 1st. What kind of an impact will that have? Any concerns about that? And also the promise, your methane reduction by 75% relative to 2014 levels in 10 years. Are these achievable, and what kind of an impact will they have on business?
Well, a couple of things. I think that the stringency, how quickly that price will rise to $130 is something that is going to be negotiated and announced on April the 1st. You have to remember our starting point was that the prior agreement would have seen the price go to $170 by 2030, which I think both Canada as well as us recognize was too fast. So we'll have more negotiations on what that stringency looks like and what the ultimate price will be, and we'll make sure that our industry knows that in due course. On methane reductions, we've made incredible strides. We've reduced methane emissions 45% below 2014 levels. We did it 2 years early. And so in our emissions reduction and energy development plan back in 2023, we had set a target of being able to get to 75% by 2035. So the federal government has aligned around that target instead of the more stringent one they were looking at by 2030. What I think is important, and I mentioned this to the Prime Minister when I first met him, is that if we could align around a 2050 target, I think that we could really work together. And that's what we've done. If you look at the nations of the world, most of them have a 2050 target. China has a 2060 target. India has a 2070 target. And so this allows for us to have the incredible wealth of our oil and gas sector, using those dollars to develop the technology that is going to decarbonize many industries. And I think that's the right way to go.
And now, getting this built, the private sector interest, is it there? We haven't seen a lot of people jumping forward and saying, "Well, is the interest there to help build this?"
I would say that what we have seen, which is really encouraging, and I think it came from the federal budget where they indicated that the emissions cap would not be implemented. Enbridge announced that they want to expand their mainline 400,000 barrels. The TMX announced that they wanted to expand their pipeline capacity by another 400,000 barrels. South Bow, which owns the old Keystone assets, wants a new 650,000 barrel a day pipeline. There's projects potentially for oil by rail. There's other ports that we're looking at, whether it's in Thunder Bay or whether whether it's James Bay or whether it's somewhere else on Hudson Bay. I think that what you're going to see is that a lot of that production will come on stream, which creates the demand for new pipelines. Our personal view is that the best opportunity for us to diversify our markets is to have another pipeline going to Asia. And that's what I'll be spending a lot of time doing in getting that to a point where we can put it on the major projects list. And we'll know then whether a private proponent will step forward. I hope they do.
And if there isn't private, will there be public money going into this?
The agreement says that we want a private sector proponent, and I agree. I mean, if we have to have the federal government build another pipeline, I think that's a failure of the exercise. The whole exercise we're going through is to restore investor confidence so that private sector dollars will be invested in these kind of nation-building projects. That's my anticipation. That's my objective. We know that we, as a government, need to get it started because there was such a lack of trust on the part of the industry. Many false starts on investing in projects where the rug got pulled out, whether it was on Keystone or Energy East or Northern Gateway. And so we believe that by being a partner with industry, that we can get it to a point where the private sector will have the confidence to complete the job. That's what we're working towards. Okay, now Enbridge and Trans Mountain are investing hundreds of $millions in measures aimed at increasing their appetites for the existing lines, with a recent TD Cowen report suggesting that they'll add the equivalent of 1 million barrels per day of shipping capacity. Is there even a need for another pipeline? I certainly think there is. I mean, I trust OPEC's expectations when you look forward into the future to 2050, that the world's going to need a minimum of 123 million barrels a day. I think we're at about 104 million barrels now. And we want to be a growing share of that growing market, especially since we're going to have the lowest carbon barrels. We think that'll be an advantage to those in Europe as well as those in Asia who value a lower emissions product. And so we know that we have a world where 700 million people don't have access to affordable energy, including electricity. And we've got to bring the billions of people on the planet who have a lower standard of living up to the same standard of living we all enjoy. That's going to take a lot of energy. And that's what I think the dual approach should be, that we've got to reduce global poverty at the same time as addressing issues of emissions. The language people are using now is that we're in a period of energy addition. There's going to be all types of new energy that come on stream, but I think oil and gas are still going to be the backbone. And with some of the decarbonization projects that we're investing in Alberta, I think that will give us an advantage in that market.
Good. Now, not everybody is for this. You've had David Eby, your next door neighbor, concerns about this. Indigenous groups have said it, yet there's supposed to be a co-ownership with Indigenous groups. How are you going to get them on board for this?
Well, we've had success with co-ownership with Indigenous groups in the past. We've got $750 million worth of projects, including pipeline projects, that have Indigenous ownership because we've given a loan guarantee. We have a capacity to go up to $3 billion worth of loan guarantees. The federal government has a similar type of program, as does British Columbia. So that's what we're beginning with, is saying that we want substantial Indigenous ownership along this line. And for my friend David Eby, he and I had a conversation yesterday. We're going to agree to disagree on certain things, but we're going to work together on other things in the MOU where we have a common interest. Expanding TMX, which he is supportive of, it's additional LNG development, which he of course is supportive of, ammonia, interties, as well as investment in nuclear, and perhaps even getting ammonia to the Port of Prince Rupert or one of the other ports. Those are the kind of things that I think we can work on together. And I'll continue engaging with Indigenous groups along a proposed future route to see if we can secure that Indigenous ownership stake. That's what we're working towards over the coming months.
Okay. Last question about the tanker ban itself. There's going to be exceptions, but there will likely be challenges. This could drag on for years, could it not?
I would say that there's a number of projects that are likely to go ahead very soon. All of the expansions that we were talking about and the optimizations, those could take place in the coming years. Obviously, getting the project on the major projects list is one step, but then there's a 2-year approval process that we would have to go through after that. And then there's all of the technical aspects of doing the construction, which of course could take years. But you've got to start somewhere. You have to start with the approvals. And that's why we're going to be investing a lot of time in figuring out the technical aspects, building the Indigenous equity stake, and then hopefully getting it on the major projects list. But the nice part is, with all of those 9 bad laws addressed to the satisfaction of the industry, those other projects are going to be able to go ahead. And that wasn't the case yesterday. The fact that we had a room full of about 150 business leaders who were pretty excited says to me that there's going to be many projects that are now going to be able to proceed.
But do you not see challenges coming to the lifting of or partial lifting of that tanker ban?
Well,
that would slow this down?
I can tell you one of the things that we were surprised by. I mean, the TMX construction dramatically reduced the differential on our Western Canada Select. And I think that that demonstrated that having more than one customer is really important, not only to our province, but to the entire country. And that's why we've embarked on this to begin with. We know that being over-reliant on the American market has created some instability. Only having them as a customer blew out our differential and was costing all of us money. And we now know that there's an appetite in Asian markets. China has purchased oil from that line. Korea has purchased oil from that line, and they want more of it. And so we think that there's going to be an important market case to be made. And if we want to open up new markets, that's the place to do it. So that's why we're committed to doing it, not just for us, but for all of Canada.
Okay, Premier, we're out of time. Thank you very much for joining us.
You bet, my pleasure.
Danielle Smith is the Premier of Alberta. You're watching Trading Day on BNN Bloomberg. We'll be back with a market update after this. More Americans are opting for a different kind of buzz to go with food and family this Thanksgiving. As California state laws around cannabis have loosened, it has spread into everything, including holiday dinner. Bloomberg's Charles Gorovin files this report.
More Americans are opting for a different kind of buzz this holiday season. As state laws around cannabis and other drugs have eased up, it's spread into everything, including the holiday dinner table.
It's more accepted. It is becoming more normalized.
Cannabis's newfound place at family functions speaks to how far the category has come. The move fits the lifestyle of people who describe themselves as California sober, abstaining from or barely touching alcohol, but open to substances like cannabis or psilocybin. Alcohol consumption has fallen to its lowest level in decades, according to a recent Gallup poll. Over half of respondents to a recent Bloomberg Intelligence survey said they now substitute cannabis for alcohol at least weekly. That might take the form of gummies, extracts, and even infused seltzers. Cannabis on Thanksgiving is a quiet tradition for some. The day before Thanksgiving is the second biggest sales day of the year for the US legal cannabis industry, behind only April 20th, or 420, which is the de facto holiday for cannabis celebration. The industry was valued at just over $30 billion last year, according to industry estimates. The cannabis market tracker BDSA forecasts growth in the total market this year of 4% to $31.6 billion. It expects the market to reach $39.1 billion by 2029. For the big Thanksgiving meal, some chefs are getting experimental. Miguel Trinidad, a New York-based chef and founder of the cannabis dining club 99th Floor, is infusing THC into his Thanksgiving menu.
Our mission statement at 99th Floor is to destigmatize cannabis through the language of food. The way I do that is by micro-infusions. What I'm making today is going to be a rack of lamb.
Trinidad infuses lamb fat and clarified butter with cannabis flour before sealing and cooking the lamb sous vide, a slow water bath method that keeps the meat tender and evenly cooked. He then finishes it off in a scalding hot pan.
So here you have it, the infused rack of lamb. It's 5 milligrams of THC. Over the course of the time that I've been doing 99th Floor, things have changed. There's a lot of people that are coming out of the cannabis closet. It's something that's becoming normalized, and people are starting to understand and respect it more.
While a few dozen states have legalized cannabis, it's still considered a Schedule I drug, putting it in the same category as heroin and LSD. Uncertainty at the federal level looms large, limiting access to banking, investment, and broader legitimacy. In August, President Donald Trump said he was considering reclassifying cannabis as a less dangerous drug, but no announcement has followed. The divide between state legalization and federal prohibition remains one of the biggest hurdles for an industry still finding its footing. In the meantime, the cultural shift is making its way into some holiday dinners.
All right, that wraps up this edition of Trading Day. I'm Roger Peterson. Thank you very much for joining us. Have yourself a great day.